Sí, menos.
Ya abrió.
Formulado.
Have a few people on YouTube and on Zoom. Please let us know that you're hearing everything.
Can hear you loud and clear.
All right, thank you.
Hey, Bob, I can hear you on YouTube as well.
Okay, awesome. Thank you. Yeah, we'll get started in a few minutes, probably about 3 minutes or so. I just want to let the room fill up. We still got a lot of folks joining. So appreciate everybody showing up. I see a lot of new names on Zoom. That's awesome. See some others. Last meeting we had some issues with bleed over. And I'm going to do my best to fix that so we don't get double talk. So probably the folks on YouTube will be able to give me the feedback on that. Future just started trading again. Let me put that on screen so you folks can see that. So all you YouTubers, this meeting will be focused today on talking about the WaveTech research tool. So you know that. Probably won't touch a lot on the markets themselves. Yeah, we just got a lot of folks joining yet, so just bear with me. Yeah, I love the chatter on YouTube, guys. Absolutely. Everything's getting a little pricey, but it's not expensive until it is. I still get some folks joining, so we're gonna let it run for a few more minutes. Be entertained by the screen of the e-minis trading. So those of you on YouTube, we actually have users of the WaveTech tool coming in on a Zoom meeting. And Zoom folks, you guys are seeing my seeing the screen correctly?
Yeah, we can see it.
Okay, awesome. Yeah, so I'm wounded today. Jason is out of commission to a point. He is
I'm actually here now.
wow, check that out.
Right, it was like a Indiana Jones moment of right at the last second, things just happened. So I'm here.
So you're like live on the internet.
Totally hooked up. Yes, live. I've got it right now.
Okay, well, we'll see how long it lasts. So Jason's been down. We have this phenomena that most people don't understand in the Arizona world, but we get monsoons every year, and everybody thinks it's a desert, and it is. But we get a lot of rain, and I just got an alert on my phone that there's some monster storm heading here. So hopefully we don't get some weird power outage. I probably just manifested it. But anyway, yeah. So we'll get going here in a minute. Still got a few more people. I'm thinking 2 more minutes. We start. I hate waiting, but I've got a couple things here to get ready. So I'll come back in 2 minutes, and we'll kick this thing off, and we'll dig into all the stuff. Yeah, Frank on YouTube. Yeah, I definitely will go through that. Yeah, they're coming in. You guys can probably hear that. So I'm letting them build up a little bit. I'll let them in the room here in a sec. Yeah, so YouTubers, let me know if you're getting double speak at all. Last time we were getting double speak on me. I think that should not happen this time. I potentially have this all figured out. Yeah, Christoph, we get some insane lightning storms here for sure. Okay, take just a break for a second. I will be back and we will kick everything off. Okay, everyone, we're going to kick this meeting off, and I do have an agenda for today. And as we did last week, I don't want to be able to, uh, I'm looking at the line, I see a lot of new people, so I want to address issues. So I will go on a presentation mode, and then you folks feel free on both sides, on YouTube as well as on Zoom, to ask questions. Now, Zoom people are somewhat handicapped because I'm not on screen there, but I am on screen on the as we go to. I'll actually come on screen here. You'll see me here live on screen. So hello everyone, and these meetings we do every Tuesday are really aimed at the WaveTech community and the people using the tool. And the theme that I'm going to have out there today is going to be very specific, and I'm going to be talking about going from being a trader to a money manager. And there's a couple private threads that I've been involved in, and kind of watching some of the chatter that's going on from that standpoint. And I'm seeing there's a lot of issues, and I'm going to address them, such as things like micromanaging trades within the system. And you might be able to make the system better, but I wouldn't count on it. The funny thing about machines and AI and quantitative analysis is it becomes more difficult to overcome something that can be so consistent, and the lack of emotions involved. And there's a number of things I want to break out today. And I talked to my original founding partner of this process right before the broadcast. And I asked him, he and I are going to do a private conversation, and we're going to record it, and then I can edit it down and bring in some things, because some of the things I'm going to talk about today, I'd like to go into more technical without getting too geeky about what's going on within the system. But I do want to have the community that we're building here on the retail side, and I know there's some advisors. I've seen some names that are our institutional clients as well. I want to go into more deep depth in the process, how things work, how we can actually build a much better understanding of what's going on internally. And that's really important. Over the years, one of the things that I have seen from the standpoint of people using the software, we have a 20-year history of people using this software. So we've actually seen every stupid thing you can do, and some brilliant things that you can do. And we've already picked up some of the community that we have on board right now. We definitely have we definitely have seen some new innovative thoughts and things come out of the community we have. And and we're getting very close here finally to rolling out the portfolio expert. We're just working on final things. One of the things that we had an issue with is getting Mac users, because it is a desktop application, and we've figured that out. We've got things running. We've got some final testing to do, but we do have it on AWS, Amazon Web Services, on their app stream. So we're going to be able to bring that out. So if you're a Mac user or some other process, as long as you have an HTML5 browser, you're going to be able to use the software. This was a big issue for me, because there's a lot of folks that are on Apple out in the community, especially in the retail community. In the institutional community, you're not going to walk into a New York trading room and find an Apple computer that's running any trading software. It just doesn't happen. It's just not the right platform. So all these big systems are running on that basis. So just wanted to give a little insight into some of the things that we're going to be talking about, and the goals of this meeting is just that. I want to be able to bring in some further insight. So for those of you that are, I wish there was like a raise your hand kind of thing here as far as, so I could see, I think there's a way in Zoom to actually, there's a way in Zoom to actually raise a hand and say, you know, and survey customers. But, you know, I would like to know, if you are a reasonably new user of the software, that you bring that up. And what I've been doing the last 2 meetings is I've been talking about the basics of the software. I'm going to show you where to find some things so that if you haven't watched these things, you should watch them. So these meetings will make more sense. And the plan is still to go into much more in-depth, much more in depth in how to use the process as we go forward. So so let's start to dig into some things, and I'm gonna go through a couple screens here that I go through every week. So you'll have to put up with this boring stuff. I know some of you have seen this before, but I do want to put this out there just so that I can just so you can get a feel for exactly what to expect here. So this next screen that I'm putting up is actually just talking about navigation, stuff like that, getting around the software. So I'm just touching on this, and I want you to make sure that you go to the portfolioexpert.com website, and that's no X or no E in the expert, so it's portfolio and then expert. And if you get there, you can go to support, and there's a drop down, and you can go to the videos. You can select them individually, but I would suggest that you watch all the videos as far as going through all that context, so you have a pretty good understanding of what's going on as far as this, the software navigation and basic understanding of things. So in past meetings, I went through a lot of detail on that, but I'm just going to mention it so we can get through all this house cleaning stuff here as quick as I can. But the menus are, once you figure out where things are, it's pretty intuitive. You know, the software, the WaveTech software is an ancient platform. It was built in 2002, and not a lot's changed. We kind of revived it somewhat from the dead. We've been on the Portfolio Expert platform for quite a few years, probably 6 years now, with most of our institutional clients. So that has a lot to do with as far as this thing still being used, and it's still used by a lot of our old clients as well. But there's, interesting enough, it's somewhat bifurcated. There's some things that the WaveTech, some of the dashboards have that Portfolio Expert doesn't, and I'm actually working on getting that stuff on the website, on the Portfolio Expert website, on a dashboard, so some of these elements you can still see even if you're using the software. So if you're using the Portfolio Expert software, and so yeah, so you know, the videos up there are just what you're seeing here, understanding research, understanding. Let's go over there just very quickly here. Let me just do that. And just so you can see what that looks like. So you go to Portfolio Expert, and this will be the final house cleaning on this stuff. So bear with me for those of you that have already seen this 3 times. When you come to this website here, you go to the support. Here's the WaveTech training. The documentation is for the desktop software. The picture on the screen is the desktop software. We're working on 2 things on getting this out, as a trial period, as well as some different pricing as far as that stuff is going. So we'll get all this stuff rolled out. We're really, really close. So I made some command decisions this weekend around this, and a lot of it had to do with the AWS ability, so that you can access it anywhere from the web. So we're we're going to limit that usage to probably Mac and power users. We'll talk about that with clients on appropriate venues. But anyway, this is where you're going to go to get these videos. You click on this, it's going to bring up a list of videos here. There's a research tool down below here. There's only 4 videos right now, and I've been filling the space. What we're also working on is right now, this is the 12th meeting, I believe, that we've done for WaveTech. So that means there's about 25 or 30 hours worth of stuff, and it's hard to find that. So we're going to go through and pull. There's a lot of nuggets, because I will get on one of these flash rolls or one of these rants that are just incredibly important and starts to reveal a lot of things that are going to be useful from the standpoint of what you folks are trying to do and all that. So so this is the place to go there. If I go back to the PowerPoint here, I think there's another page. Yeah, so we'll talk about this. And typically, now I'm glad Jason's online, because he can port some stuff over to me if I need it, if I need help. But the goal here is to show you how to use and we will go through the step-by-step process. And there's always little things I kind of cook in my little mad scientist room over here. And what really is happening with a lot of stuff with me is I'm trying to get to what I'm going to bring up a subject here in a few minutes. It's going to be talked about, and I'm going to reinstitute some of these strategies and some of the fundamental screening ideas that we have. There's just little minor issues with as far as getting distribution to these things. But this screen here is talking about, there's a portfolio wizard, so it walks you through step by step, and then it's a modeling tool. It doesn't track your actual portfolio. That's done at your custodian or your broker dealer, and then it does have the ability to back test your ideas, and it also has the ability to for you to go as far as back testing and doing a lot of incremental testing and walk forward strategies. So this is where that happens. And so what we're going to do here is we're just going to go ahead and start. I'm going to put WaveTech on the screen here, and we're going to talk about a couple things just up front to start to dig in there. And the theme that I wanted to utilize today, or to talk about, is how to get out of a trader mentality and how to become a money manager. This is a money management process that's on the screen. It is not, it can be used for trading, don't get me wrong. The research area can bring up a lot of ideas. And what I've seen from a lot of users so far, because you guys are trader mentality types, is trying to micromanage every trade that comes out of this system. And part of the reason why we have the back test and all that, if you start to especially in a portfolio environment, and I'll show you this in a few minutes, especially in a portfolio environment, when you start to interrupt the process, you could make it better. Absolutely could. I'm not saying that's impossible, but most likely what you're going to do is make it worse, and you're going to take a lot of elements. And the reason why I mentioned Dave, my original partner, is one of the things that we did back in the day was when we were looking at building a portfolio management process, what we wanted to do, the equation that we were trying to solve at the time, was how to automate an entire process, when to buy and sell and how much to buy and sell, and then how to allocate ideas around when we had more ideas than we had money. And we had another equation that was involved when we built this platform. It was 1998, trading was very expensive. And so we had to not only achieve and answer that question I talked about, but we also had to answer the question how to keep trades to a minimal and still achieve a very dynamic allocation process and be able to get money to grow and to do a lot of things. So I'll save that in-depth conversation when Dave and I record. We were talking a few minutes ago, and I think you'll enjoy that, those of you that want to really get involved and deeply understand what we're doing. But the reason why I talk about the trader mentality is, and the allocation strategy, and I have some basic things I'm going to show you today, and then we'll move on to questions and answers today. But I do want to make this upfront presentation part, which I usually do at least a half hour or so, just so we can get some context. And then we'll open it up for YouTube and for the Zoom folks that are going to be able to ask questions directly. And I think I've got it figured out, so YouTube won't get double speak. I'm looking at the settings on the software I'm using, and I think we're going to be okay as far as not double hearing what I'm doing. And so the whole idea of what the allocation process that we built was aimed around all those equations I just talked about that we were trying to solve. But the other part of it that was the dynamics within a trade. So if you look at a trade and it bought, this is going to be my first example, and then I'm going to dig into some portfolios and talk about some things. But if you look at a trade, you may look at a symbol. Maybe we bring up, let's just click on some random symbol. I don't even care what it is. Basic materials. This is on a daily, and there's a couple other things I'm going to address when it comes to portfolio management here. But I'm going to drill down a little bit. I'll just grab Air Products because it's here. The very first symbol on this list. So one of the things that you will see, you're going to have winning and losing trades. This is on a short-term model. It probably does much better on a weekly model, but I just wanted, this is concept, philosophy, and I want you to understand this so that you'll see that you're going to look through all the trades and go, this one's fair, but there's a dynamic that happens when you start to build a portfolio. So I'm setting this tone of, I'm going to gradually move you into the portfolio idea. But if you just look at the buy and sells, you might have, my example is let's say you bought, it shows that you bought, the entry point was $10. The stock rallied up to 14, but by the time it sold out, it actually lost $1. I'm making this up. So what happened is net, we lost $1 on the trade. But when we start to get into the portfolio dynamics and we build a portfolio, there's these reallocation cells, which I will show you here in a minute. And you will see losing trades from an entry to exit point turn into profitable trades. And I'll show you a couple examples of this. And the reason why that happens is the reallocation orders, they're actually reallocation cell orders, will cause incremental pieces of trades to be reallocated or sold out, and taking that money and put it into a new idea. And I'm going to show you these dynamics in some of these orders here in a minute. And the reason why this is important is it comes down to portfolio construction. It comes down to the constituent list that you put in and why you choose it. Now, what I'm seeing so far from a lot of folks in the community, that the way they're trying to find ideas is the raw output of the database. And that's going to be probably, I'm going to call it the least successful way to actually build a portfolio and take you, that's the trader mentality. Okay, well, there's all these trades out there. There's still good ideas out there. but those aren't necessarily, those are trading ideas, maybe not necessarily good portfolio ideas. And what my plan is for next week is I'm going to show you how to use fundamental analysis to choose your constituent list, and then how to bring that constituent list in to the manager, to the virtual portfolio manager, and then how to make decisions on what goes in, what goes out, and how to do a maintenance mode. If I went through I went through that PowerPoint before, and I've discussed these things, and I don't think the dots have been connected, because when I've looked at a couple of these threads that I've been involved in, I can tell people they're not getting what I'm talking about. And I think it was Saturday morning, I was on a thread participating a little bit, and what I saw was just that. I said, this has got to be the subject for Tuesday's meeting. So I know this is pretty dry. We'll get into questions that you guys have here in a minute, but these are important concepts in looking at portfolio management versus a trading type situation. And one of the elements in being a portfolio manager is allowing the portfolio to evolve, giving it enough time to be able to evolve and to actually actually allow the portfolio to work. Now, when you get into this, and I'm going to go into some portfolios and show you this. I'm going to take it from abstract into the physical so you can see it on screen. But when you go from just trading stocks, just trading S&P and doing all those things, and you start to build a dynamic basket of ideas or stocks or a concept, and Jay has been, my son Jay has been really good at building and taking what we call thematic or themes and building portfolios. And also we've done a lot for 20 years of helping people bring in fundamental analysis, which I'm going to do next week, bringing in fundamental analysis and screening. So we're still doing qualitative and quantitative looking at quality of companies and looking at the quant stuff, and going to combine those two things. So the plan is next week it will be a Geek Squad, okay? And the Geek Squad will be going through some really heavy details as far as that stuff goes. And I think it'll be interesting to some, and it will be absolutely terrible for many other folks. But the concept here is important to understand, because this is my goal as far as the I guess I just want to come on screen because this is my goal for the community. And if I ever say bad things about the investment community, investment advisors, it's those that don't use our software, that are still locked in that 1952 pie chart, allocation strategies. There's a lot more than that, okay? And so when I'm talking about that, but it's going to be important that for you folks to go from a trader mentality to a portfolio manager is for you to understand the dynamics of a dynamic basket, which is something that's willing to rotate symbols in and out. So it's fearless when it buys, when it sells. It doesn't go, oh gee, what if it goes up after I sell it? It doesn't have any emotions built into it. And that's super important to understand from the standpoint of how this is going to work versus you and I as this discretionary emotional human being, right? So we're taking the emotion out, and we're also going into a basket of stocks. And the reason why portfolios are going to work, it's going to not be because of we pick the best buy and sell points. It's going to be because of the constituent list. So there are going to be symbols that you could actually bring in that have reasonable performance. And I've talked about this in other meetings. So today's focused on just on these reallocation trades, on somewhat of bringing in more of a conceptual viewpoint of how to choose a constituent list, because it's all about choices here. It's all about stock selection, and going random and going to going to the WaveTech database and using that stuff will find ideas, but are they the right ideas for a portfolio? And I'm not sure they are. I think they're going to be way too random. And one of the things that I have preached, you folks just met me in the last 4 months since we started this channel, but it's important to understand that randomness brings randomness. And what you need is structure, ideas around your structure. So fundamental ideas, you need and this is what I'm going to start developing in next week's meeting, is you need structure in selection process, you need structure in how things come in and out of the portfolios, and then you need some review process to do this. And none of this sounds all complicated. It's not. It's actually going to be very incremental. And I'm going to, I've got a bunch of old videos from about 10 years ago. I really look good. I always said I didn't want to turn the clock back. I think I want to turn it back about 10 years. I looked pretty young then. That was pretty fun. But the point of a lot of the videos that I did was aimed at the advisory community and for those folks to use this. So this is what we're presenting here to the public. To the best of my knowledge, folks, I've not seen any other process in over 20 years that looks anything or does what this thing does. And this is why I'm spending the time to show you folks how to actually get and construct and build this thing, because my goal is for folks to manage those 401ks. Say, I see it different. I'm a baby boomer, and the baby boomers have helped build the advisory community. And if you go on advisory blogs and look at what advisors are talking about, you know what they spend all day talking about? How to figure out how to latch themselves onto to the younger crowd, maybe the millennials, or maybe some of the younger Gen X folks, right? They're trying to figure out how to latch onto them and get them into their businesses. What I'm trying to do here is saying, no, you don't need to do this. And this community builds. I can tell you, we are working on automating this entire system so that you can build a customized strategy that will be absolute. All the trades will be seamless into your broker dealer. And you can run this on the side and hopefully on a really amazing web app, and it'll all be automated, which you can sign off and say, okay, just do it. Here's a chunk of money, run it. And you don't have to sit here and watch it every day, but you are going to need to interact with it. And we do have some pre-built strategies, and there's some things that we will roll out to the community that we will manage, and we will do all the things I'm going to teach you. But I will tell you, there's something to be said for having that pride of ownership, to have that you built this, and then you start to see the results. But you're never going to see the results if all you're doing is looking at every trade every day and go, wow, is this one winning? So, and we're going to dig into those dynamics as far as the, we'll dig into the dynamics of the portfolios here in just a second. So I'm on a typical Bob Kendall rant on this stuff, but I think there's a lot to be gained from listening to this, because I want you folks to be successful at using this product. If I can get it so that you can manage what I call the serious money. Everybody's got play money, and I realize, but when you get out of the speculative world and you start to manage money and you allow baskets and dynamic baskets to trade over time, you'll see some amazing things. And what you'll see when you build a portfolio, and we built several, I'm in the right account today, but we built several strategies here, and I'll bring up some things here in a few minutes. But I think what I'm going to do is 2 phases today. I'm going to end this rant. I'm going to ask what kind of questions that came up. We'll go if you have questions on YouTube, you can put them on the timeline, and if you have questions on the, on Zoom, you can just bring up your mic and we'll do it that way. And we'll try to address both. And I'm really super glad that Jason's got live. So I'm on screen here because at some stage, it's just nice to get a little more personal with these presentations. So I need to figure out my Zoom screen, and but then that'll get really weird for those on the on YouTube, because now you're going to see two Bob Kendalls. That could be scary. So what I'm going to do here is I'm going to show some of these dynamic trades that happen. I'm going to go full screen here. I'll show all the dynamics of what's going on within a portfolio and looking at some of these events. And maybe Jason Kendall, you might have some comments about this. And one of the things that we talk about a lot, and I'm going to emphasize here in a minute, is that you want to make sure that you're getting a certain amount of these reallocation trades. And I was talking to Dave, my original partner. He did a white paper in 1999. And then a guy that worked for me for years was CFA. He actually did another white paper on that. And I'm trying to dig these out of the, I found one of Dave's white papers, but I forgot to ask him if he has that, because he never gets rid of anything. But we also had another study done, and this was the result of the study, and why I'm spending so much time talking about this today is because it's so important to be successful with this product. Is these reallocation cells, what was identified is that we get 65%, I think it was like 67, but roughly 65% of all the profits that are going to be generated in a portfolio or in a dynamic basket is going to come from the reallocation process. And that's the important to understand. So if anytime you avoid those trades, we've had advisors we worked with over the years go, oh, we never do those trades. I go, well, congratulations. You just eliminated 65% of the profits that you are going to earn. So if somebody said you can run something, but you're going to eliminate the profits, 65% of them, you're probably going to change your mind. And that's why I wanted two things. I wanted this to be documented in a live show like what we're doing today. And I want you folks to understand this so that the level of success in using this product, it will become important, will become significant. And all of the things I'm talking about, you don't find these out in 3 weeks, 5 weeks. You have to actually go through what I call a market cycle. Now, I was looking at it was interesting, just on that note, I was looking at the 52-week high-low, and the 52-week high-low was, March and today, right? So, I mean, and on the S&P points, I think it was 1,400 points, which is unbelievable, right? So the volatility is huge. So we're living in a unique time, but nothing's going to change. In fact, a lot of these portfolios that we built live on this show, and some other things I've brought in the past, I brought in concept of how to manage a set of ideas and do that. These videos need to be cropped out and found so that you know exactly what's going on there. But the bottom line is, this is a very powerful tool if it's used right. So let's go full screen, and I'm going to show you some of the dynamics, and then we'll go to some Q&A stuff. But we go over to the virtual portfolio manager, and I'm just going to click on I think these are all short-term strategies, but that's okay. The only thing I want to display here is I actually want to get to the trade log, and this is perfect. This is all I want to talk about. This is what I've been ranting on for 35 minutes, about 30 minutes, is that these are trades that are coming in and out of this portfolio. They're being dynamically sold, and it's showing you the price. But there's a couple of things that happen, and this is interesting. I want to follow this Apple trade. This is actually a new Apple trade that just came on because we got in Apple, made a substantial profit. We got out and we rebought it. So I'm just trying to find. I want to find Apple here somewhere. There's reallocation. Just trying to. I'm way too far back. Hang on. Oh, there it is. I just found it. On 420, here we go. On 420, I'll highlight this line. We bought 47 shares of Apple at $277. Now this is what I'm talking about in the dynamic environment that we're creating here. So Apple is still long the trade. We printed down a little bit today, but this trade is still long. So if we start to look, I'm actually going to take this off. I'm going to draw some things on the screen. This will be better. Okay. So we're going to point out this trade right here. So we bought Apple here. And then as we go up the list, you know what? Hang on one second here. This tool freezes my screen when I do this. So let me get it so I can see everything I need to see before I do this. Okay. Okay, this is it. So down at the bottom of the screen, when I'm going to draw in, this was the original purchase of Apple on this particular trade. Way down here, now that was a sell right here. We bought it. And so we bought it at 277. And then as we go up the list, we find Apple again up here. We bought 47 shares. And so on 7/28, Apple didn't issue a new sell signal. What happened was we had more ideas than cash and said, okay, what do we sell? Well, we sold this block right here. These are the sells that we initiated. We sold some Tesla. We sold 3 shares of Tesla, 10 shares of Apple. We showed PFE. This is all what we sold. And these amounts over here are the dollars that we raised in the portfolio. And the reason why we were raising that money in the portfolio, because we had new buy ideas. And so I'm trying to find a way to display this like in PowerPoint or a chart or something. But what's happening here is we're lowering our exposure in these stocks. So we sold some Tesla, we sold some Apple, PFE. These are all stocks. If we look down in the list down here, we'll see here's the PFE buy, right? So we just bought that. We bought 491 shares. PFE sold 117 of that. What did we buy it at? So we made a little profit. We made $37. We bought it at $37.49. We sold it up here at $35.48 or $38.54. And so we made a buck on that trade. We sold 117 shares. And what we did is we took those profits that we made from that and we reallocated them up. I'm going to have to take this off and I'll show you where that money went. But this is what happens, and this is why these reallocation sales are so important, because two things are happening. And this is a concept. So one thing that's happening, trades that are already working, we're lowering the exposure from that trade. So we own less of that. So we started off with 491 shares. Now we sold 117 of PFE. And we took that money and we put it into, you can see the buys right above here. We bought ABO and AAN. So we put like $13,000. So we raised a bunch of money here and we bought those shares up there. So what happens, and this is somewhat complex, but there's a redistribution of profits, and also the new buys have a new probability. They have some of these trades, especially if they're long in the tooth. This is a very short-term model. If we had a weekly model up, then we would see much more dynamics. We may have bought, we may have bought a symbol 6 months ago or 8 months ago, and it may have appreciated 20, 30, 40%, and now we're selling it down. It's much more dynamic, and I'm gonna, but this process that's going on here is harvesting profits and redistributing the money. So this is a gaming theory, not a portfolio management. You're going to read this in Modern Portfolio. You're not going to read this in a Modern Portfolio Theory manual from academia. This is gaming theory, which is the idea, the concept of taking profits on something and redistributing to a new probability. And Dave and I will unpack this on this call that we're going to do. For you nerdy types, we'll dig into this whole concept. But I just want you to understand, this is really what we were working for, were the things that I told you early on, that we were trying to solve two basic equations. And the two equations we were trying to solve was, if we had more ideas and money, where do we get the money from? And why do we get it from there? And how do we do it to cause the least amount of transactions? Because transactions were expensive. Well, it's funny, that second factor, it really is what was driving us to do some of the things we did. So I'm glad that we went from totally expensive to free. And, and I know I'd see some of the European customers, I know you folks don't have it. I actually just saw a presentation the other day, how far behind Europe is on the broker-dealer side in offering a lot of things that we have here in the U.S. It's crazy, actually, when you look at it. And even though Interactive is a pretty good broker-dealer, I don't know what they're able to offer because of the securities laws over there. And I know there's a lot of really weird stuff that you guys are stuck into over there. And so, in this world in the U.S. now, we have the ability which to do a lot of dynamic type strategies, and now it's free, and very soon on a large level we're going to have the ability to do fractional shares. Now we can do that with Robinhood right now, but Robinhood's interface to the markets is terrible from this viewpoint, trying to do basket trades and those kind of things. I have every intention in the world, once we finish a couple projects, of going to them and showing them how we can empower their community. Okay, and that's going to be significant. But this concept here that I just presented is what's going on in all of these portfolios. So I'm going to take all these arrows off. But if you look through a portfolio, you're going to see these reallocation cells. And I've told everybody, and I'll tell you folks the same, when you see all those cells, just smile, because that's money. That's profit taking. That's harvesting of profits. And these are really good things. And you want to make sure that you do those things. So I think I went on a rant for a lot longer than I thought I would, but I feel that this concept is really important. And I'll probably go on to at least one more little mini rant about why you want to follow the process, and how, and I think I'm going to save most of that for next week, how you build and construct and how you walk forward a portfolio, I think is what I'm going to do next week. So I'll stick to this concept today, and let's go ahead and maybe bring up some questions here of stuff. So there is a way to raise your hand. I see someone did that. That's cool. Okay, so yeah, if you can, that would be kind of cool if there's a way to raise a hand. But go ahead and ask a question if you have one there.
Hey, Bob.
Yes.
Hi, this is Steve. Maybe this is something you were just referencing for next week, but I'll just throw out the question in case.
Sure.
When you were mentioning walking through or walking forward a portfolio, I guess my question was, and this is something Jay was able to help me with a week ago. I emailed him with the same question, but it may be helpful to everyone out there today listening. If you say you construct a portfolio that you're happy with,
Yep.
and you want to actually start the process of allocating capital to the trades, my thought was when you run this portfolio, you have all these positions, you have a hypothetical amount of money you're going to allocate, and you have all these positions it's telling you to allocate.
Right.
You wouldn't take your entire lot of money on that day and buy those exact amount of shares, correct? You would. So the question is, how would you approach layering in to the portfolio and making sure you're purchasing like the most current recommendations that are showing up as a current buy?
Yeah, so the answer is no, you would actually match all of the orders. Very simply. Because there's no way you're going to get the portfolio performance unless you own all the constituents. So that's something that we've dealt with. Steve, are you in the business or?
I am not.
Okay. You sound like you could be. That's a good question. But yeah, so the answer is, yeah, you would match them. If you like that portfolio, the consideration before I'll preface that with, if you've reviewed all the positions and they're not, if you remember on a previous screen where I had the, matter of fact, I'll bring it up while I talk about it. Actually, it'd be good to bring up this screen here where we have the understanding the statistics and models. So you reviewed all these current open positions, and they're not too far off to the right of this thing where they're very extended trades.
Yeah.
Okay.
That's where I was going with Jay.
Yeah.
And we ran into that snag where I said, well, some of them are long in the tooth, so I don't want to buy them today.
Yeah.
So, but some of them are not, and some of them are current buys.
Yeah. So here's, and this is like super good because this actually goes to what I'm talking about today. If you buy a mutual fund today, that's what you're doing. You're matching everything they own.
Yeah.
Period. And what you have to count on within the portfolio construction is that thing is got the right, got dynamics that meet. The other things you can look at is trying to think if we can generate that. But this is the number one thing, right? The number two thing that you can go to is when you go to, I'm trying to think where the best, yeah, right here. If we go to performance just on this portfolio, and let me do a comparison. Let's compare to SPX here. So one of the things that I want to look at, this is super important. So there's a number of, this hasn't been discussed at all ever so on all 12 shows that I'm aware of. And, but what, on this little grid here that we built, so we have something really interesting. The average drawdown is 2.9%, right? And what we want to see is what our current drawdown is. We'll talk about that here in a second. And so this is a daily strategy, so it's very aggressive, but we have a average drawdown of 2.933, right? We're going to go over to the summary page, and we're going to look at this thing. Look at this. We're at an all-time new high on this strategy, right? So if this is what I hope I can connect the dots here for you. Let's say this portfolio right now was down 2.5%. Okay. And it was almost at the 2.9. What it tells you is the average drawdown from the portfolio viewpoint from the basket is 2.9. So anything if you see a current drawdown, this is another way to look at a portfolio. If you look at the average and I think, let me go back a page here. I think there might be average, actually the Sharp on this thing is just awesome, 2.4. But if you look at this thing, this DDFI, what that stands for, drawdown from inception. So this one here is a drawdown based on the 1 year look back, but it's the same number here in this case probably because of the crazy volatility. So and this portfolio, yeah, this is 2015. This goes back to 15. But anyway, so what we want to look at here when you're deciding to implement a strategy is that this one's at an all-time new high. So you probably have a 3% average risk if you bought all the constituents. Does that make sense?
Yeah.
So if you just bought, you could buy Apple, right? And you could have a 10% downside. But since you have this basket, if we go back to our open position run, since we have this whole open position run, we have a lot of diversity in this portfolio. This thing's just not going to blow up on you. And that's the point of having multiple securities, having the models attached to them, and going over to the trade profile page of actually seeing, not trade profile, I'm sorry, trade log, and going to trade profile and seeing, that recently we had some sells. So it's actually downside some risk in this thing if this was your portfolio, right? But I would still, like, if you see a drawdown and it's 2%, 3%, you're probably within a range where you can just put all those strategies in exactly how they're allocated. When you go to the open position, you're going to allocate them out exactly as it looks here. So in this portfolio, we're AAN errands, we're putting 5.58% into each, this is what we're allocating out by symbol. And if you built this up from right here, and we just did it today, it was at an all-time new high. I don't know what, maybe it downticked a little bit today, who knows? Everything was at new highs again. So it's possible that would not be the case. But whatever it was, your downside on average in this portfolio is going to be that 3%. So if you have to ask yourself, if you could buy a strategy and you have a downside of 2 to 4%, is that worth doing it? And probably the answer is yes. And that's why that actually makes my whole point. That's probably the best point of the day, is by having this many positions on, it also limits your volatility that you're going to get as well. Okay. And I'm going to bring trade profile up here really quick. Is that going to, yeah, this is going to tell me something else here. I just want to look here. Yeah, so this page here, these are things that haven't been talked about before when I've talked about the system. This is digging in more. We spent a lot of time talking about individual trades and research and all this. As we get into here, this tells me on this portfolio that it has an average per day trades of 0.44. So I think we got 19. So this thing is going to generate, I used to know these factors off the top of my head, but this thing's going to generate quite a few trades. There's probably going to be 150, 200 trades. This is a short-term strategy, right? In a year, probably going to have 125 to 150 trades in a year on average. And then what it also tells us is a standard deviation per day, but it tells us that what the average long. So it tells us that the average long is 164 days, standard deviation 60. This is, I'm going to have to look at the models here in a second. 285 max average days, 285, and then durations and all this. It also tells us something else. The average long positions per day is 12. So right now we have 19. Markets are making new highs. We own a little bit more than a standard deviation. See, standard deviation is 4.5. That would put us 16, 17. So we're just a touch over one standard dev. And the maximum has been 23 and the minimum's been 1. So this tells us a lot about the characteristics of this dynamic basket that we're building. So this, at some stage, this portfolio had one stock long, okay? And it probably, we could all guess when that was. That was probably, sometime in February. And this thing liquidated out. It could be at another point in time without going through the details. But these are all, when you start to look at implementing a strategy, these are things that you look at, because these could be, I think individual stocks are going to do well, but I also would like to, I want to look at something really quick here, just so I have some context here. Yeah, so okay, that makes sense then. This was a combination where we put weekly and daily symbols in the same strategy when we built this. Okay, so we've got a little bit of both. That's why those durations, when I go back to this page here, that's why those average durations are at 164 and they're not 35. So it's not completely a short-term strategy. So this is a blend, this is a hybrid of this is a hybrid of everything as far as that goes. We're really looking at a combination of both. So if it was all weekly, that average days long might be closer to 200 or so. And those are market trading days that are being held. Okay. Long answer. Tell me what I missed. What you.
Well, I heard you on you would match everything day one, and I guess our approach when we talked through it, and let me know if you agree or disagree, but was to run them after you back tested the model, say the 5-year back test, and again you came up with a portfolio that you liked. Run that same model back to just like the last 100 days, and then it would trigger how to layer in and sort of give you day-by-day entries to build on.
Yeah,
that approach work?
That doesn't matter. Here's why. If you do it 100 days, chances are all the trades that you have on are still live in the original position. So you're not going to see, typically, not a lot of material change unless they were longer term. If it was a weekly strategy, you might see some dynamics there that maybe that 100-day look back changed, but it's really the best way. And that was another white paper that Dave and I did and worked on way back in 1999. Was this question is, okay, I built a portfolio, how do I get in? Do I scale it in? Do I put incrementally over the next month? Do I just go all in? All that. And the best answer always was just go all in. But you want to look at the metrics, like making sure that the portfolio just built aren't a whole bunch of stocks where you're just buying risk, because there is a way to do that, right? If you got all these trades, if you're buying Apple and all these trades are through the roof, you're buying risk. Maybe it continues on, but you're buying more risk than you are future benefits. That's why, going back to this chart I'll put back on the screen, that's why understanding where this duration is, and I said I was going to do this, I didn't get it done, but the other thing is sorry about that, how much of the trade profits have been realized as well. So let's say that normally it makes 30% and it's up 33% and it's held the symbol 200 days. That's not, you don't want to match that trade, right? What I would do is probably take that trade out, leave the back test, take that trade out, find something that has a better profile, and then build it that way. And rather than trying to cut them off at the knees and trying to build it the other way, I would look at the metrics. If I'm in a drawdown, awesome. How much of the drawdown, of the typical drawdown in the portfolio, in the basket of stocks, is actually been realized, or like I said, it was 2.9 in the portfolio we were just looking at. If I'm at 2.932, it's a bargain to put that strategy on, no matter what the duration is on any of this stuff. Okay, and looking at it from the basket is a much better way than trying to go down and micromanage each individual trades. You want to look at that, But once you build that portfolio and you're happy with it, then you match it. That's it. And you just look at it. The best perspective here is that when you look at it, it's the same thing you're doing right now. If you took your favorite ETF, your favorite mutual fund, right? No matter what, you took those symbols and you bought them, you're buying every constituent that money manager owns at that moment. And some of those are long in the tooth, right? And so that's why you want to look at the volatility of the ETFs, drawdowns, and that stuff. Much harder to do that because you can't see it. Jay built a strategy, which I can bring up expert maybe and show it but he brought up he built a strategy. We have a company that we have that we can get the constituent list from ETFs. So we went through all the clean energy ETFs. He did. I said we, but he went through all those things and he picked out all the symbols in there. And then we evaluated them as we've showed you on this program to do it. And we found the symbols that worked the best, had the best constituent profiles, all that stuff. And we built a portfolio with it. That thing's up 75% this year, right? And the back tested was amazing. And this was built a while back, but it's that's what you want to do with this strategy. So this is what I presented, I think, even last meeting or last couple of them, they're all blending together. But the concept of building your own ETF or your own personal mutual fund, this is what we're giving you the ability to do. And you get to control the constituents. You get to choose what goes in there. Sorry, you gotta be careful when you ask me a question. Sorry. That makes sense, though? I mean, I think that's beneficial to everybody.
Yeah, it does.
Okay.
Great, thank you.
Yep. Sorry to get so long-winded, but that's a really big concept to understand there. Verily. Hang on, let me see if I can. Yeah, I got my speakers all the way. Hang on a second. Try it again.
Okay, can you hear me now?
Yeah, I hear you. I can hear you enough to answer the question. I don't know if it'll get over to the channel, but that's okay. Go ahead and ask the question. I'll just repeat it.
Okay. Few questions. The first one is, I also have the portfolio expert software here. What is really the difference between what you have on the website and the program itself? And the benefits of that? The same.
Yeah, the trades are the same, but it actually is capable of doing what we talk about as you can trade symbols on multiple, on what we call a multivariant level. So you can trade on daily, weekly, monthly, and you can trade the same symbol as many as 6 times different ways. Okay, so it's much more dynamic, and there's other elements that it can do. You can actually control aspects. You can actually build your own allocations. You can do a lot of different things with it.
Okay. And another question is regarding the futures. Is there any way to add them to the portfolio?
There's not at the moment. One of the issues with futures, it was interesting. I used to run a CTA, a commodity trading advisor, and I built the technology. The models actually work fine on the buy sells. I don't think we have the database, and the problem with them is the reporting on it because the futures have different increments of value. So $1 isn't a dollar. If you look at soybeans, it's different valuations for a tick, all that kind of stuff. So from actual returns, you could see the buy sells, but as far as evaluating those things, it's all the issue there is the increments of, what a contract actually is, what $1 is. So, $1 on soybeans is different than $1 on the E-minis, for instance,
All right. Yeah, because the thing is like, for example, there are a lot of good options regarding the ETFs. restricted in Europe and trading ETFs right now.
Oh, really? Where are you at?
In Amsterdam,
Okay.
in the Netherlands.
Okay.
The broker actually doesn't allow us to trade unless they're based in Europe.
Okay.
I think it's country determined.
Yeah. Yeah, that's what I was saying. Like I said, I did see a presentation that was really interesting, just basically showing how many things aren't available in Europe right now in the investment world. It's amazing, and that's probably an international restriction to the broker. I don't know. Have you looked at Interactive at all? Are they available?
That's where I'm at.
Oh, you are. Okay. Okay. Yeah. It comes down to, they're probably the most flexible of everybody internationally. And so they're the right broker over there, but they have so many darn restrictions. I mean, if you remember 2008, they stopped, you couldn't short sale and all that kind of stuff. So, there, some of the restrictions on trading there are I don't know what the right term is. They're very highly restrictive. So you can't trade any international at all, right?
Well, we can trade everywhere around the world. We just can't trade the ETFs.
That's what I meant, ETFs, yeah.
So, but you can do all the other options for markets and everything.
Okay. Yeah. Yeah, so
Yeah, I'm not quite sure about the mutual funds except for when they're based in Europe. It has something to do with country restrictions where it comes down to translation, what the ETF stands for.
right.
So I think it's even like different. And then I had another question regarding the WaveTech tool when you said you were going to automate it, or you were going to get linked to the broker or something?
Yeah, the hope is we got a little pilot program going right now, trying to figure out how to get the information, the percent buys and all that, be able to look at your, link up with your broker so we can see, you can allocate out a chunk of money, and then we would tell you how many shares to buy based on that, whatever chunk of money. It doesn't have to be the whole account, but it would be, it would definitely be, where you would be able to put a dollar amount in there, which would be really cool. And also it'd be, and the good news is Interactive. I have a partner that we're trying to figure out some things. He's on the institutional side, but he's got a direct pipe to Interactive where he can access into the back end of their system with authorization by account. And we're trying to figure out if we can get something on retail, because it's all money manager type business that he does, and he's looking into the probabilities of being able to get retail access. And I've got another group in New York that I've been talking to as well, because that's a big equation. Because if we can do that, now you can. It's basically my goal is to build a robo advisor that would be able, you can set up and build these things. You can control the constituent list, and ultimately, even on Portfolio Expert, you could even control the allocations and how the money is allocating by symbol and all kinds of dynamics. And then you can actually backtest all those as well. So you're going to have a really good feel on the what you're creating and what you're turning loose to the world, especially in a fully automated, I agree, just do the trades kind of thing.
Yeah, because right now already in Interactive Brokers, we are able to allocate, instead of buying shares, a certain amount of money.
Right, yeah, because they were actually the very first to implement the fractional shares or buy by dollars. Absolutely, yeah. And the good news is this friend of mine and a fellow we're trying to do a strategic deal with is that that's what we think is the best place to start is with Interactive, because they've got a pretty much an open door kind of strategy with a lot of stuff. in the U.S. here is Charles Schwab's and TD, which is the same thing now, and Fidelity's are very closed kind of networks. They're much more restrictive, but it does appear that Interactive, and I found a broker dealer. I noted, I don't know it right off the top, that I found somebody here in the U.S. that might be a pretty interesting partner as well that I'm planning on trying to look at, because we've been looking at some of the new offerings, and especially in the incremental area, in the fractional shares, as well as being able to automate these trades. Is that's like the top of my list of things to do. I've got the engine, I just need to be able to route it, and that's a big issue right now.
And then another question: the portfolio examples that you have, for example, like when you go to the virtual portfolio manager part, it seems like my side of things is like missing certain things. Like we were talking about recently about buffer error, for example, portfolio and stuff like that. How are we able to access those examples?
Yeah, so here's what I want to do with you. I would like to get on a one-on-one call because it's really hard to hear you, but I want to be able to answer your questions. So are you at Skype?
I do have Skype, but not on the computer.
That's just the easiest because I can do a quick screen share. So why don't you send us an email to info@Kendall report and send us some contact info. And I would like to talk to you about this. I think it would be good. Okay?
All right.
Yeah, appreciate it. Appreciate it, Dave. So another question, folks?
Hey, Bob, this is Viviano. Can you hear me?
Yeah, hear you fine.
Yeah, so you were talking about the reallocation cells. So when a portfolio manager issues the reallocation cells to fund new ideas,
Yeah.
Does it evaluate the returns of like the new ideas versus like the current positions, or does it just purely look at which current positions have the most realized profits?
That just the last is what it does. It looks at the total net profit that's out there, and it says, okay, this one's growing the most. So here's the theory behind that, and why this was. You have to remember, this was a decision that we made, David and I made way back in 1998. And what we decided is that one that had grown the most also represented the most risk to any kind of drawdown. So if the market turns around, and it was actually pretty good thinking because we had this thing called the .com bust, .com bust right around the corner, right? And so there were stocks we had. I remember we bought Qualcomm at $35 and it went to 900, right? And we were selling that stuff incrementally, like I showed you. So we were chopping off the ones that grew the most, and it worked out. It's always been a good strategy, but that it doesn't care about what the forward-looking returns. And that's a report that I want to build, because you can go to the trade profile and you can see what the expected returns are. It doesn't mean they're going to happen, right? But you can look out and you click on like here. Let me find something that's reasonable. These are all these giant trades, but I don't know. Look at Tupperware. I'm going to pop up this on the screen, and so we can see that it's 74 days into 147 day possibility. But of course, it's blowing. Look, that's pretty crazy. So is everybody buying Tupperware? Is that what's going on here? I guess so, huh? 24% is the mean, 56%, and it's up 383%. So some of this stuff is just off the map, I guess, as far as.
I'm actually promoting Tupperware. That's why.
That's what happened.
It's in some of my portfolios, but some clients thank me because they made a bunch of money. Like, it's Tupperware. I just made a bunch of money. Thank you. I'm like,
yeah.
It just came in my head. I'm like, I don't know, something Tupperware, and it's doing what it's doing.
That's pretty funny, actually. So yeah. So but yeah. So that's all it's doing. It says who's growing the most. I need some money. How can I raise? Think about the original equation was how do I raise capital and do the least amount of trades? And that's where most of the money's at, right? It's growing in that top end of the portfolio. So I'll just grab money off it's called top slicing. As a matter of fact, some of my old Brit friends from London who taught me this top slicing. They go, just top slice it, mate. Just get rid of the stuff that's growing too much. And that's exactly what we do. So we take clip the tops off until the process will develop a linear allocation number. So as you go into, let's say you had 20 symbols, now you get 25 symbols, it's going to go into 25 divided into 100 minus a factor, so we leave a little cash so you don't overspend the account. But it goes into that factor and says, oh, everything should be 4%. I'm just making this one up. And so if that trade is growing to 7% and you have 3 ideas, we may only have to sell, we'll sell it down to 4. We'll get down to 4. There's 3% there on one symbol, and the next symbol maybe it's grown to from original 5 to 8. We'll cut that back 1%. We've got the money to buy 2 trades, and we only had to sell roughly maybe 40% of one and maybe 10% of the other. And we raised the capital, so we want to keep them because they're good stocks, but we also know that we're downsizing the risk. Like I think it's just looking at an example I put on the screen a little bit ago is looking at the, looking at selling Apple. What's wrong with selling Apple in this parabolic move? Nothing, right? It will roll over. I know everybody believes it'll go forever and it's going to split 4 to 1 and it's going to go back to where it is. Maybe it does. Maybe I'll eat crow. But the bottom line is that's not how it works. And so, but those are that's the only consideration.
Got it. So does that mean that if I, want to take advantage of this effect, that then probably having a, portfolio with a lot more diversification is?
Yeah.
And like if you only have airlines in a portfolio, then it might not be able to rotate into other things. Yeah.
So here's my airline strategy. This is one. If you watch, I think I built this last show or the previous. I don't remember.
I think it was like 2 weeks ago.
Yeah, I think you're right. And but you can see this is what it's done. It went up, it's back. Now it's rallying again. So my airline stocks, and if you look at, that's exactly right. If we look at the trade log here, we've got some reallocation cells, and the way that factor is generated is by the allocation factor. And Jay's the master of playing with that number. You want to address that, Jay, at all?
My RealWiz?
Yeah.
RealWiz portfolios?
Yeah.
I love actually altering the initial allocation factor when you're first building a portfolio. Whatever, and Bob's going to show it right here, so we'll give you a real good visual look at what I'm referring to. But there you go. Yeah, the initial allocation factor. So whenever you put all your symbols in and everything, and you are in the initial allocation factor portion, it'll give you the recommended number. And I never suggest going any lower than a number, but I always go higher, which means it's going to participate even more than what it's recommended. So it'll actually go in more often and look at everything and reallocate, determining what's going on with the market.
So this is this is an example portfolio. So let me write down some numbers. So we get 87.73 returns on this portfolio this year, the way it's built, right? So I'm going to go in and I'm just going to click on this modify button here, and I'm going to go right in here to that allocation factor. It was at 1387. I see it's already put. What do you want to put in here, Jay?
I would actually go with replace the 1 with the 2. So instead of 14.44, go 24. Hey, I don't mess around. I really beat these things up. Sometimes I will go like if it's 1387 or that it was 1444, maybe I'll go 1744. But when I'm feeling radical, I go 2444.
Yeah,
I
and
usually bump another 10, put an extra one on.
so anyway, that's
It'll
really,
show. It'll be dramatic. It'll show the change. It's
yeah.
good for a training.
So here we are. We're at 8739. I just queued it up and reran it. So this is one of the things you can do on that initial build, and Jay even plays with the mins, right? The minimum trade amount.
Yeah, the minimum. Yeah, it was like usually $1,000 per trade is the minimum, or 2,000. On some of the application, on some of the portfolios I've done, I actually noticed if I went up another 1,000 or 2,000, it forced it to do something and actually invest a little more, and it actually performed better. But that's something you're gonna have to test on your own and see if it works. But I would say only maybe 15 or 20% of the time that I tried that did I actually get a better result. Usually it's minimal at best, but a couple times I clearly got a much better result.
Yeah. So take a look at this thing. We went from 87.73 to 92.78. So we gained 5% by playing with that number. So this is something that you can go and just play around with to see what kind of factor, and especially in a small subset, right? So the two ways you can go is more diversification. I like the one of my mentors, my early mentors, used to always say, would always tell me that diversification was the fastest way to moderate gains and moderate losses. He knew if you want to make money, it's concentration with a strategy. And that's what we're presenting here. So you can go in and concentrate this thing and play heavy duty. I should have looked at the position sizing before, but we go to open positions. They're all bigger than whatever they were, or they're more, actually there's probably, the couple of things we should have looked at before we change that is to see what kind of effect how many reallocation trades and stuff are there. But this is, you have control over this stuff to play with it. And this is a sandbox. So maybe you build one that you're really happy with, you do another one and just go radical, as Jason said, and you start to, let's play with these numbers.
Can you go back to modify that portfolio? I wanted to kind of go over that one more time, and maybe I got a little too excited and I may have talked a little faster, but I just want to go over it a little slower so that everyone does understand. So, okay. Yeah. So right now the portfolio, the system is telling you this is a recommended allocation. So 0.1444. Now, to start testing, I only would go up a little bit. So instead of 1444, go, like I said, I think 1744, just to kind of nudge it up a little bit, see how it reacts. But there are times where I will just, whatever the first number is, I go a whole nother number. So if it's 1444, I've gone 2444. But again, that is getting pretty radical. That's really pushing it up there. So
yeah, so now I put in 17, allocate, finish, click the OK button, and let it rerun. And it's in the queue, 92.7. So we went from the original, from the 14, actually it was 13.8, 13.87, I can remember that. So this is 92.97. And if we go in and let's see what this is doing now, it's still in the queue, so it's going to take a second. It's interesting. There's 5 orders on this thing too. I didn't notice that.
Yeah, and I think maybe when you first, on the initial allocation setup, I think it may have been 0. I don't remember, but yeah, I think when we bumped up the allocation factor, it caused a few more sales.
Yeah, that's fine.
Orders.
I want to show that then. Okay, so now it's 91. We went by changing it to 17. We got 91.7 versus 92.97. So it's about 1%. And these 5 orders here, if I click on the 5, is some new buys and reallocation sells. So I wonder how it looks like we bought. It's interesting. We bought Boeing and American today and Spirit. and then we had 2 reallocation buys. We sold some Delta, we sold some SkyWest. So that is the run for today. And yeah, there must have been some buys anyway. So
and so just to clarify, so when you bump up this number, what it's basically telling the portfolio managers to try to like take us more profits, do more reallocation sales, and like try to fund more ideas. Or
yeah, so what's going to happen is it's going to take bigger bites on everything. So let's say we were 100% cash and you boost that up to the 24 like Jay suggested. It's going to take 24. It's going to take 4 stocks is going to basically fill the portfolio. The 5th trade, we have 9 in this scenario. The 5th trade is going to cause a reallocation because you're not going to have enough money. So now it's going to go from 24 to we'll just round it up. We got 5. We're going to go to probably a 19.97 or something, a little bit under 20. And we know that we're shooting at a moving target. So when we give you like these orders that are on the screen right now, we have no idea what these stocks are going to print on the open tomorrow. This was for the open today, right? So we do know what these printed at. When the servers run here in a couple hours, it'll actually show where these entries and exits all occurred, and it'll show up over in the trade log. But this is so we fudge this, we downsize the position size so we don't overspend the account. So in this case, we're maxed out. If I go back to the summary here, you'll see that we only had 1.49% in cash. So we got the pedal to the metal on this one. We got all the money being used, and so now we have these orders that we put out. So what were we buying? The orders we were buying 3 symbols, American, Boeing, and Save, and we're selling Delta and SkyWest to raise money. And if you notice that it also shows you percent redux over here as well. So the current is 0, it's going to 1091, and the Delta Air was at 11.5, so we sold 0.5% of that. Saves a new buy, and the other reallocation with SkyWest was 11.8. It's going to 11. So what that means, actually, we can see this, and we go over to summary. We actually had some cash on hand. We had 1,443 in this account, so we did have some cash. So we took that cash plus the 2 sales of the symbols I just mentioned, which were Delta and SkyWest. We sold that money. We raised the capital so that we can buy that symbol. So we can buy those 3 other symbols in a combination of the cash and everything that we're buying.
And just another question. So on the other side of that, so when it's trying to figure out what to buy, I see that there's like the projected percent. So does it consider that, like if it has 100 new ideas, will it try to sell to fund all the 100 ideas, or
Yep.
Is there okay?
Yeah, it's going to take them all. It's what its instructions are. I got 100 new ideas. If we went to we run the S&P 500, all the stocks in there, that stuff happens. You might get 60 new buys out of 500 symbols on a day, or 100 new buys. It's going to take and reorganize the pie chart, going through the top down, the top slicing, and taking you all the way down to the to this, so that everything fits in that 100% pie.
Thank you. That's all I have.
Yep. Thanks.
Hey Bob, this is Bill. I have a question.
Yeah, Bill.
So as a portfolio advances, does that factor change? And the reason I ask is I've been doing a lot of back testing, and I noticed that the portfolios are sitting on quite a bit of cash, and I'm wondering, do you have to change that factor as the portfolio advances, or does the system do that automatically?
Yeah, so if you have a lot of cash, that probably you're running a weekly strategy or something, or
It's a mix.
okay. Yeah, just some of those symbols like we saw, I've been talking about it on the channel, is that the, you know, we've seen a lot of, you know, exits, especially on the short term. We saw some new buys come in last night, but, you know, we've seen literally, let's go over there and take a look at that. Let's go to research and go to daily. So the short-term models were probably getting hit. Go to all stats, and you'll see here that we had almost 1,100 and some buys last night, almost 1,200, and so and then the previous. But if we look down here, we've actually had between the two models, there's been 7,000 sells versus about 2,500 buys. So most of that has been that from that standpoint. Baby's hungry. Yeah, the beauties of parenthood. Yeah, you just unmute your mic when you're ready to go again.
I actually had a quick thing that I wanted to ask to show. I'm getting a couple questions on the YouTube chat.
Okay.
Can you go ahead to one of the portfolios that has at least like a 5-year back test? We just want to show the year-to-date numbers so they get an idea of what it looks like.
Yeah, I'm not sure what these are. Probably any. Probably.
Is there any that go back?
Yeah, I don't know. These are all random stuff. Yeah, this goes back 5.
Oh, there we go. Yeah, just so they can kind of see what the year-to-date numbers and the monthly.
Yeah, so down below here.
Yeah, down below. Yeah.
Yeah, so this was a random set of symbols that we grabbed out of nowhere, out of thin air. I think these are top. What's the name of this portfolio? Option Daily. So this was a daily portfolio that we took a random set of stocks. I went to I Googled what are the top volume options traded on individual stocks, and I grabbed the top 24. I think it was the top 50, and I just grabbed 24 randomly, threw them in here, click, 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 and built a portfolio about that fast.
Okay, and that was with Charles, right? As you're looking for the.
Yeah, I don't know when it was, but yeah.
I thought it was maybe that.
Yeah, but we just grabbed it to see what was going on, and you know, so that's how we got that. But these are year-to-year numbers, month-to-month, all the monthly returns, all that stuff. So it's interesting because this is random 24. There's 14 stocks long right now, and there's 20% in cash, 18.63. But as I look at the equity, it's at an all-time new high as of last night. So that's actually, there's so much that we could spend hours and days talking about. And I guess as we look at this is meeting number 12 like this, that we actually have spent days talking about this. But you don't have, in this case, you don't have to have 100% of the money working to push a portfolio into a new high. You need the right stocks working with enough allocation. So I've seen strategies that have 40% in cash and are still able to print new highs. And it's not about, you don't have to use every dime in this environment to make money. And that's been a misconception for years of folks thinking, well, markets are really strong, we need to put more money to work. No, just this is what I'm trying to get out today, is you let these strategies grow and build and allow them to work on the constituent list that you told it to watch. This is a random list, okay? Zero time with, I don't know, I guess not zero, but it probably took me a minute to Google, to type in top option stocks, grab a list. It probably took me longer to copy the symbols so I could get them in here than it did to actually find them. And so there was absolutely zero effort done at all on this. And it's a random set of stocks, and you'd be pretty happy if you ran this for 5 years. I would
Yeah,
think.
it's a pretty good portfolio.
Yeah, I was
Like
told.
you said, for putting 5 minutes into it, let's
Yeah,
just throw this
I doubt
together,
if
see
there's
what it-
5. There might be. I guess we'll give it the benefit of the doubt.
Well, yeah, we'll just
But
round
the
it to
point of
5.
it is, and the point is this, you know, I don't know when we built it, but, you know, we probably built it last month sometime, maybe. I don't know. I don't, that's the one thing I wish we could see is when this symbol is built. I think there's some stuff in the database you can see that, but we don't display it. But this, so even if we did it in August, we did it beginning of August, that's okay. It still made 4% this month. So, I mean, but the point of this is to demonstrate everything that's going on, and there's been a lot of stuff. Another question here?
Hi Bob, it's Wayne. How you going?
Good. How you doing?
I have one more question with the allocation cells. Just say you were, you've got some allocation cells that have come up, and because you're buying something, and you've gone, well, hang on a sec, I've actually got a bit more extra cash laying around, and I do want to put it into the market.
Yeah.
So instead of using them allocation cells, I'll just put the cash in to buy that stock.
Yeah.
Then would I go back? And add that value to when you're doing the portfolio builder and rebuild the portfolio with that new value?
No, I get exactly where you're going with that. I don't know if we should venture into this world, but we built something called, there's an allocation tool that we built. It's somewhere on our old website. I'll have to see, I'll consider digging that out. It's just a spreadsheet with a macro built in, so you can put the values, and it will actually build that strategy out and tell you exactly how many shares to buy. But here's what happens, and I understand the logic, what you're saying there, is what happens is if you have more money, you want to allocate that money across the board, actually, on all of the stocks, not just the one. So, and you don't have to change the value of your portfolio you built to achieve that. You just go in and figure out what the percentages are, what you own, and then you buy the somewhat close to that shares. I know in that, excuse me, in that spreadsheet that we built, it actually gives you the ability to round up or round down, and we always say round down. So you want to under bet everything as you're putting it together. So, yeah, so you'd want to actually allocate that new capital out across the board, because otherwise what you do is you start to get out of balance, and then the orders that start to come out, the goal is to match the orders and be in sync totally. And then when you get instructions to buy or sell, you've got exact instructions on how to authenticate that portfolio. Otherwise, you're going to end up with a slight, you're going to be over allocated, or it's just going to be out of sync. And what happens when, you know, Jay could tell you, we had a client, we won't say where, it was in the state of Arizona, and Jay already knows who I'm talking about.
I'll be quiet.
And they had.
I can tell the story. I just won't name names.
Yeah. Okay. Yeah. But they were constantly out of sequence. They were, hey, our portfolios aren't returning the same as the system says we should be, and we started digging in. I don't know, Jay. You want to go for it here?
I can help with that story because I had to run the numbers. I had to do the work for them to see what was wrong, because they were trying to think it was our system.
It was a
WaveTech.
Complete cluster. Let's just put it out there.
And it took me a while. I should have got paid extra from them for doing that, but I was trying to be a nice person and help and customer support and friendly relations and all that. But yeah, they were just saying, we can't figure this out. What's going on with your system? Our books are not matching what WaveTech's showing us, what Portfolio Expert is showing us. How come that is, you know? And then I said, okay, give me your books, give me all your information and your buy and sell orders, and I'm going to make this easy. You've already got it on the screen. So let's say Amazon bought 7. They only bought 1. Okay, TSM sold 185. Well, they only sold 130.
Right.
Well, how do you expect the numbers to match when you're not doing exactly what the system's telling you, of course I'll be nice. It's common sense. If you don't match what the system's telling you, the numbers aren't going to match.
Right, and that's the goal, Wayne, to actually get it to that level. So, and if I recall, are you in Melbourne, Wayne? Did I lose you?
Yeah, so in Queensland on the Gold Coast.
Oh, you're in Queensland. Okay, yeah, because I was talking to a friend of mine in South Melbourne, down around the Horn a little bit. But anyway, I don't like the condition.
That makes total sense because so my portfolio is unbalanced at the moment, and yeah, so the first priority here is the extra cash is rebalance the whole portfolio.
Yeah.
Exactly what
Yeah.
it should be. That's
Yep.
very important. Yeah.
Absolutely.
I can see
Yeah, because and that's that was the goal of this meeting today. Hopefully we pushed you folks a little better. Is matching is important. Being able to allow this process to happen, looking at those drawdowns so you can kind of get a context where you are. What you should see is, let's say the market decides to roll over, okay, and it rolls over next week or this week or tomorrow, right? What you'll start to see is that the portfolios will start to take protection. They'll start selling out of positions. They'll start raising capital, and what you were likely to see on those numbers that I was showing you on the performance tab. Here, I'll bring it up on this performance tab. When you get down here looking at these drawdown numbers, let me just put an index on here for fun. When you get into the drawdown numbers here, is that you're gonna start to cap off those declines around 2.5. It might be. I thought we used to put a standard deviation here somewhere, but yeah, there's a standard dev on the rolling returns, but not on the. Yeah, there's not one on a. On the actual drawdown, which that actually would be handy. But you're probably looking at standard dev. You could go to 3.5%, 4%, and these things will cap out. Really, it's amazing. And that's why I was setting up the scenario, especially if you build something new and you're trying to match, and you look at the drawdown once you built it, and the drawdown's like at the average, or maybe it's a little more than that. That's a perfect time to match that strategy and get it implemented. It doesn't, maybe the drawdown's going to be bigger. Maybe that wouldn't have been a great idea on, I don't know, February 29th of 2020. But, chances are we were already in a lot of cash on that because we were selling heavy in January and early February. So it should have been the other element, especially when you get into, which we haven't seen yet, which we will, is a corrective phase when we start to build cash. And you'll start to see how this thing starts to protect, and the downside drawdowns once you start to raise cash, then the beta of the portfolio changes substantially and has less participation on the downside, and also on the upside, any rebounds. But you're going to mute out that decline just by when you start to build cash, when you see something go. And like even this portfolio we've been playing with here has a 20% cash factor. So it changed the beta. I'm making this up again, but let's say the beta was, 1.3 beta on the upside, and now we've reduced it by 20 cents. It might be 0.9. It'll be something different. And as you build more cash, it'll actually be where the beta might drop to 6 or 4, depending on how much cash you get. So now you're only participating in maybe 30 or 40% of the downside action. So, the upside and downside capture numbers change. There's a whole lot of factors. We actually have some sheets we're trying to figure out how to automate them so that everybody can have them, that actually talk about upside, downside capture, and a whole bunch of different elements. But it's all happening. It's just not displayed there.
Okay, great. Thanks, Bob. Thanks,
Yep.
Dan, for that.
Yep.
Hey, Bob, it's Steve again.
Bob, this is.
Just to add on the matching question, I don't know if this is getting too far in the weeds. Are you matching the actual if I go to the portfolio report, and you can print out the positions,
Yep.
the CSV.
Yep.
If you do it that way, it gives you the actual number of shares. If you just do
It
an
does.
view, it gives you a percentage.
Okay, but that share amount is to the model. So if your model, if you have a different, if your account's never going to match the model from that viewpoint. And I'm going to try to bring that up. So open positions. It's coming up here. 1 second. Give me a second.
Yeah.
So yeah, so it's going to show you these numbers here, right?
Right.
And so this is the share amounts that you're talking about. But that's going to be, if we go back to the summary sheet here, that on this particular strategy, that's for a $286,000 portfolio. So I'm not sure. We put that in there to build some other reports originally. And so that's the reason why that number's there and why you can export it. But yeah, so that's going to only match if this is for a $286,000 portfolio. That's going to be your share amounts based on, we go to the open positions page here, based on these percentages of that 286. That's going to be your share amount. So you're always best to use this percent to go by percent. So, okay.
Hi, Bob. This is Matt. I had a question that's kind of related to the cash question. That was when we're looking at dividends, we have some stocks that we've purchased and they're in our portfolios, but they have ridiculous dividends. I mean, these are tanker stocks and they've just been pumping out a ridiculous amount of cash. So the dividends are up at around 30%
right
a year.
Wow. Yeah.
And I mean, so they just have been dumping that out, but of course the share price will fall, and then that changes the WaveTech model.
Right.
So I was just kind of wondering how you handle dividends being put out. Into
Yeah. No, that's a
the
good
fastest way.
Yeah.
To do that. And then I had just another question. So there's the dividend question, and then our portfolios. When I built them and put them in, I did a optimize bi-weekly and daily. So
Yeah.
I just put the symbols in the bottom and just let it figure it out.
Yep.
Is that the way you've done it, or do you typically keep the weekly and dailies separate?
Yeah, that's a loaded question. That's a good one, but yeah. So it really comes down to one of the things that I talked about when you're building these things. Depending, the whole conversation today is how to go from a trader to a money manager, is to actually write down what the goals of that strategy is. Like pretend you're actually running a mutual fund and you have to put out to the public, here's what this strategy does. And if the strategy says I'm going to trade short and long term signals, and obviously that's always with goals of capital appreciation, it's a standard disclaimer that every mutual fund puts out there. But when you start to break it down, it really comes down to that. You could run two separate strategies and blend them together. That's something that could be done as well. You run two separate pools of capital. I don't know how easy that is to do in the environment you have.
Yeah, that'd be fairly easy to do. I mean, I put them in there because I'm testing out different different portfolios. So I just kind of put it in there and let it figure it out, because I wanted to kind of see what the results it came up with. But
what was the first part of your question?
Portfolio, it's just not,
Yeah.
I don't know if that's going to work that well. So
what was the first part of that question? Because that was
the dividends.
Yeah. That's
the dividend reinvestment.
Yeah.
How you calculate that.
So unfortunately, we don't track the dividends in here at all. Okay. And so what you're going to get when it goes X, those dividends could actually cause a sell signal. in mutual funds, we see that all the time. But mutual funds, there's a way to adjust the mutual funds for the dividends so the price changes, but on stocks, there is not. There's not a capability there. So you could see symbols get kicked out on a dividend like that. And that's a little more complicated. I think what I'd like to see, Matt, is that there's a way, maybe one of the things that can be done. Can you do it? Yeah. We'll have to hook up with you because you can share that. We can see that portfolio. So we just need to know, and you can do this offline. Send us an email to info@kendallreport.com and put in your username and the name of the portfolio, and we'll take a look at what's going on there, see if there's any weird stuff going on.
Okay. All right, thank you. That was it.
Okay, thanks. All right, we're 2 hours in here, I guess. It's getting late on the East Coast. Let's do one more. Maybe if you've been sitting there listening, watching, and you've got that burning desire, last call, I'll go for a couple, but I'll try to keep them a little more brief. You guys, you're gonna let me off the hook? Come on.
I have a question.
Okay, awesome.
Seems like if I'm putting like 30 stocks into the portfolio and then trying to manage the buys and sells, it's a pretty cumbersome task. And then you talked about it being automated. How soon do you think until that is?
Well, so here's the issue. It's really, I don't know for sure. I started in the software business in 1992, my first effort, and a friend of mine taught me a lesson: never sell something that doesn't work. So I've already made that mistake. Okay, I've already told you about something that's not available yet. So that was bad idea number one. But yeah, so I'm not sure timing, but you can rest assured that it is top on the list of things that need to be done. And the issue is also two-folded. If you were an investment advisor, this would not be a problem because you have access to trading baskets. And they have all of these things, but they have never released them to a retail account. So retail access doesn't have access to some of these things that would make it super simple. And that's why I found a potential broker dealer that was actually talking about doing basket trading. So if we had a basket trading firm that would allow us to put these percentages and build a dynamic basket, then that issue would be super simple because it's right there on the order CSV file. We can export this stuff super easy. But the problem is there's no mechanism for you on the broker to actually authenticate it. So that's really frustrating me because I know all these systems exist. So I don't know if these broker dealers will wake up. My guess is we're going to have to build some way to get these trades to be submitted, and they might. It's not a big deal, but they're probably going to have to be submitted, one at a time. Even if it's automated, it's going to buy Apple, sell this, at one trade at a time, and submit the order and get the confirmation and submit the next one. They won't. There's no one out there that I know of on retail that I've been able to find yet that is actually being able to, do a batch order. That would all be fixed instantly. It is a big deal, especially if you're running a short-term strategy and there's a lot of trades. I'm not sure that was a very good answer, but
Hi, Bob. Hi, this is Kelvin.
hey, Kelvin.
Yeah, I got a question with regards to buy and sell. I was wondering if it actually takes into account of the PPMs, as in the momentum. So, for example, if you have two stocks that has a buy order, and one has a huge, high PPM, maybe 2.5, and the other one has just 0.25, does the system take into account of to buy the one with the higher momentum and not buy so much of the one with the lower momentum? So that will also take into account of the reallocation cells and sell less of the one with higher momentum and sell more of the one with lower momentum.
Yeah, so it's probably going to do the exact opposite in a way, but not for those reasons that you stated. But yeah, so it all it looks at is if it's brand new buy we're talking about, right, Kelvin?
Yeah.
Yeah. So if it's a brand new buy, maybe one of the triggers that maybe that was PPM 1 or something that was spiking up, but PPM 2 may have been the trigger point depending on the configuration. So it may not just be that the short-term momentum might be stronger, but the intermediate, longer term may be at a place where it's ready to buy. So it's looking at basically the configuration of the charts. But this is something you can do. Okay, so let's say you wanted to make that decision. You could actually command the software to do that simply by maybe deactivating the symbol that was going to buy. And let's say you didn't like that buy, so you could turn that buy off, and then it would automatically buy more of the other one. But the system itself only looks at the pattern that it's recognizing, and that it's what it's saying when it issues a buy. It's saying that the probabilities for prices to appreciate are high enough that it wants to take a risk based on the criteria that's in the system. There's about 60 rules, and there's like 600 variables it's looking at, but it boils it down to sometimes just a couple signals that are told that this is priority for that signal to go ahead and buy.
But is that recommended, or should I just not mess around?
Listen. There's, yeah, no, it's a great question. I'd almost have to, like if it's a common thing that's coming up with you like that, right? One of the things that'd be maybe really cool where we can get maybe a little more dynamic on these shows, or just not doing Zoom, but maybe having the ability for you to submit a screenshot or something so I could see what you're talking about would be kind of powerful, right? Just so I could see exactly what you're looking at. But if it's a situation that you're looking at and you see this, and here's what I would do, and this is only going to be trial and error type strategy, is that what you would do is look at the strategy from the standpoint of, okay, here, here's where it told me to buy and sell, and let's say you decide to do what I suggest and you just turn it off. I'm not going to do the trade. Well, you're going to find out that you probably should have done an opposite, right? The one you deactivated was the good one, and the other one it didn't work out just because it's lower momentum, feeling like it's got a better opportunity may not be the case. These things are so dynamic. But you could do that and say, you know what, I did that. This is one of the things that I plan on bringing in as we go further down our trail through the community, and evaluating when to bring things in and out of symbols and portfolio maintenance. But this touches on that, is that maybe what you want to do is maybe even take just depending on how detailed you want to be. If I'm going to turn you into a portfolio manager, then you probably want to screenshot that situation and then track it. Maybe put it into a watch list and track symbols that you looked at that you were unsure about, and then see how they performed and see if your decisions were good decisions or not. That's something we've talked to folks a lot about, is when you decide, if you make a decision to, like, I don't like this trade for some reason, doesn't matter what it is to document it and actually have a log of those type of things are really handy, because you can go back and say, every time I see one of these, this never works out. You know, this is not a good trade. You know, and I've cautioned everybody about buying 52, you know, some symbol that spikes up and then it gives a buy signal, go find something different, right? Although I think Tesla did that. It was a pretty good trade. I think Apple actually did that. It was a good trade. So it comes down to knowing what you're trading as well. But I would track those.
Yeah, because I was wondering, like Apple and Tesla, they have so much momentum. I'm a bit hesitant to sell them and, you know, buy a penny stock or something like that that is just starting to, you know, have a buy signal.
Yeah.
So I was wondering how to deal with that.
Yeah, those are things that you're gonna, without knowing symbols, I don't think there's any general rule, but that's something you need to just kind of learn with the system going down the trail, you know. So, you know, it's one of the things and that I wanted to do on my early rant. So only a few people will hear this ever. That only people are willing to hang out for and look at the 2 hours at the end of this thing. But that's pretty much all that that you have to go by is just to track, look at them, and see if you can identify situations that aren't good ideas.
And for the last question, I was thinking of the market summary page, where you have you mentioned the 68%, the 65% of the overall market.
Was that on the research?
Yeah, yeah, like for example, the daily.
Yeah.
Yeah. So now it's weekly. For example, daily. You mentioned on I think 2 YouTube videos back that if it breached the 68%, the market short-term wise is looking like it's going to correct. Is there like a guide on the thresholds? Like 68% means a certain thing, 50% means certain things, and 30% the house is on fire.
There's some basic rules, and on this the 68%, we did breach that. We're at 64.92. If I go over here to the all stats page, we picked up like 1,200 new buys last night here. And yeah, so it's kind of, this is a real dynamic, unique situation we're in, just because of the way the markets have rebounded and it's V bottom. It appears this is going to be this is a learning experience even for me, is that we have to see how this thing reacted. So we went down about 62%. I talked about this on last night's video. We went from 90 down to 65. We went back to 90. Now went to 62, and now we're seeing it rotate again. So we may not get that rotation. And of course, the markets on the intermediate models, you know, we've moved up to 69%. And those intermediate models have a larger impact for longer term holding. So, you know, we're already seeing, you know, I think I did 2 videos talking about the emerging risk, and the emerging risk went out the window really quick. And I was getting a lot of trolls on the site telling me, well, 2 days ago, yeah, I did say that, but you know.
Yeah, but they didn't take note of the figure that you mentioned correctly, the closing figures.
Yeah, we didn't get the numbers, and everything flipped. And you know what? Those same people would have been telling me how wrong I was, because if I would have said, oh, stay short or do whatever, you know. But yeah, that's the reason for it. So this dynamic, what I was expecting to see is just a liquidation. We'll see how, you know, today we're printing, you know, new highs again. So we'll see how this thing plays out. It'll be, the numbers will be out here shortly.
the reason why I ask is because sometimes in the YouTube video, like for example, when you mentioned the 68%, then you go on to say there is a X probability of the market correcting, and you know the probability figures that you mentioned, the percentages. Is there a like a table that you know, like if ppm is above a certain amount, it means 10%. If it's a certain amount, it means 20% of something happening. Is there a breakdown, or is it
There's
all
not, but
completely
it's
through experience?
it's not, but it's certainly something that I could probably put together. That wouldn't be that painful, but yeah, because I do
Yeah,
have some
because
numbers.
the guide will be very
Yeah,
good, because
no, that's a great.
we do look at the graph
Yeah.
on the WaveTech, and sometimes we just squint, you know, and try to zoom in, and we go and look at it and see 0.5. But what does that? What is
What
the
does that mean?
percentage
Yeah.
on 0.
Yeah.
What does it mean?
Yeah, I probably need to do, like, I did a video on the ppms, but I think it was very general.
Yeah.
So I probably need to do like an advanced. I'm making a note to myself, like an advanced vid on some of those numbers, and maybe. But there are some. There's a number of sequences, and I'm sure you've been watching the channel that you've seen that the where I talk about momentum precedes the price movement, and then they go into that sideways mode where it just maintains the trend. And that's, you know, that's what we've been seeing on a lot of stuff. And stocks are a little more dynamic because you have more volatility, and actually there is a correction going on. All you got to do is look at the Russell, right? So like we saw this summer, I brought up on this page right here, we have basically 8,000 symbols sold. I guarantee you some of these stocks are getting hammered, right? But it's not Apple. And it's not with Apple and that top echelon of stocks are keeping these indexes buoyant, right? So you're not going to see a big decline in the market without Apple rolling over. And obviously, you know, all the top end of the stock. There's, I think, something like 30 stocks are dominating, you know, the entire index on the S&P. And so yeah, so there's definitely. From an index viewpoint is one thing, but that's why these dynamics and inside the portfolios, and especially if you're bringing in a lot of diversity into your portfolio from, you know, from different types of sectors and different types of capitalization and all that stuff, you're going to have some dynamics. So you might see, like the one portfolio that we randomly built had 20% in cash, but it was able to still render an all-time new high. So, you know, those are the kind of dynamics looking at a portfolio viewpoint, then, you know, trying to figure out. And the best part is if I flip this over to the weekly and you see the 68%, this is like ultra bullish, and it's ultra bullish for the next 100. I mentioned this, I think, a couple of videos ago. Maybe it was Monday's video. Is that there's 160, 80 plus days ahead of us. So like if we go to the all stats page on the intermediate and we look at the current optimized returns, right now the duration fulfilled is only 18%. And the average duration here is 205, and we've got only 38 days on average, right? So we've got 160 potential market days ahead of us that these models are going to stay long, or indicating that there's an intermediate trend. So when I'm doing my work, I'm talking about looking at the PPMs, looking at the projections and some of the stuff I was talking about last night, you know, 3,500 handle, 3,600 handle in the S&P. That's where this has to come from, because this database doesn't roll over. The short-term database is much more dynamic. And what I was talking about there is I thought we still could, if we could still see some rollover, you know, what's going to happen when everybody that thought they could buy Apple on the split and it goes down, you know? that's probably what's going to happen, right? Because everything's already been built in. So, we saw a little pressure, a little selling ahead of time, but, I guess the split happens today on Apple, right?
On Friday, I think.
Oh, is it Friday? Okay. Yeah. So, yeah, I've been meaning to look that up. So, yeah. So so when we come in Monday, and that'll be something we'll have to watch closely, make sure the split gets adjusted right. So we'll have to
Can I add something?
Sure.
Real quick? I actually just wanted to say shout out to Kelvin, if it's okay. I've been helping him a lot over emails, and we haven't been able to connect over the phone yet. So hey, Kelvin, I wanted to say hi real quick.
Yeah, thanks so much for your help. Jay has been helping me a lot through the emails.
I've been trying. I don't know how successful sometimes, but I've been trying. I'm there for you. I'm trying to pull for you.
Thanks. Thank you so much.
You're welcome. Thank you.
And thanks, Bob, for the answers. Thanks.
Yeah. I think, some of this stuff, like I said, with everything from which trades to go on, it's not, it is to a point trial and error. You've got to look at the statistics, look at the models. You got to look at what kind of characteristics they have. Have there been, I went over this in other videos, has there been consecutive winners or losers? Maybe if you got 4 winners in a row, probably the next trade's not going to work out, maybe. And especially you look at trade location. There's a lot of considerations, but when you go in and you build, what I'm going to go through next week is when you go in and build a portfolio strictly from a fundamental viewpoint, you start scrutinizing from a combination of everything we talked about, and you start looking at them from there. Then you bring in a different dynamic, and it goes to also that entire pool of assets that you're managing versus looking at, the individual trades that you're putting on. Though that's an important concept, because you get too into the individual trades and you're going to start micromanaging, and maybe the stock right now that you've got in there isn't performing very well. And especially on these intermediate models where it's going to hold for 200 days, maybe that thing draws down, it goes sideways, doesn't do anything for 3 months. You think, man, this thing's a dog. Meanwhile, it's sort of like you've got these other leaders leading the portfolio. Well, when they start to top out, all of a sudden those trades have been on for 30, 90, 100 days. All of a sudden they start to work, and so they rotate in and bring in value into the strategy at different times. And maybe theoretically you could find other symbols that are going to add more value in. That could work, right? But if you're just building this pool and it's based on a concept or a theme or something, if you let them run, they're going to go through these cycles. And that's the hard part of being to that point of I guess, patience and allowing the system and the basket of stocks that you built to produce whatever they're going to produce. And that just takes time. There's no way around that. All right, we're seriously, this is the last question. 2 hours and 24 minutes, so we do 2.5. That's pretty much what we've been doing with these things. Anybody?
Bueller?
Yeah. I was thinking that, actually. All right, well, I guess everybody's done.
Thanks, Bob. This has been great. Great information. Thank you.
Oh, you're welcome.
Yeah, I wanted to agree wholeheartedly with that. This is Matt. Thanks, guys.
Hey, Matt, appreciate it. Yeah, listen, if you guys have some questions, and I'm just going to put this out here. We still got like 30 folks on Zoom, and also on YouTube. This is possible, but maybe we need to have like questions that you send us ahead of time, and we could actually do a whole Q&A type. that might be something to do. And then we just have like a whole meeting. You folks send in the messages, you send in the stuff and see what's going on, and go from there. And we can answer a lot of that stuff. All right, I'm going to call it, and appreciate everybody spending the time doing all that stuff. Is pretty awesome. Spending all this time with you folks, I really appreciate everything. So yeah, just yeah, make sure you send questions or anything you can to us, and that feedback button is a pretty good place to go. But yeah, so I'm just hoping that I can get you folks to be able to successfully use the product, run your money, protect it, grow it, all that kind of stuff, and especially with all the opportunities out there as far as things are, and as far as being able to get no transaction fees, ultimately eliminate all internal fees on all this stuff. So I really appreciate it. Yeah, I guess until tomorrow we have another live stream. So tomorrow will be fun because we'll go through we'll hit the markets and all that kind of stuff, and we'll go from there. So thanks again, everybody, for watching. Really appreciate it, and we'll see you tomorrow if you got time to hang out with us again. All right, thanks again.